The decade that began with an economic recession caused by the bursting of the dot-com bubble would end with the bursting of the housing bubble, triggering an economic crisis that spread from the United States to the rest of the world, with consequences that continue to be visible today. This is a story of corruption, greed, incompetence, and fraud, and the largest economic collapse since the Great Depression, the Great Recession. During the 80s, Wall Street experienced an unprecedented period of expansion where commercial banks, investment funds, and brokers began to grow and become an increasingly significant part of the economy. With high salaries and bonuses, they were able to attract talent and capital to continue growing and become one of the most important sectors of the U.S. economy. Although part of the growth in the financial system is normal as a country's economy grows and evolves, this only explains part of the story. During this decade, the industry benefited from a lengthy process of deregulation and innovation in financial instruments and derivatives, which facilitated increased leverage, increased complexity in the financial markets, and diversified the portfolio of services in the sector. The most relevant innovation for this story was the mortgage-backed security, or MBS. This instrument was created by Louis Ranieri and initially consisted of bundling a large number of high-quality mortgage loans. Those who acquired them received payments from these loans, but thanks to diversification, these instruments had very low risk and therefore received a AAA rating, allowing pension funds to invest in them. This instrument, at least in its early stages, served as an example of an innovation in the financial sector with benefits for society, as it allowed for lower mortgage interest rates due to the reduced risk of these loans. However, Wall Street quickly blurred these benefits. The arrival of MBS created a dangerous incentive for lenders. Traditionally, banks had only provided mortgage loans to people with strong financial stability and prospects for being able to pay not just in the next few years, but over the next few decades. The benefits were also realized over time as the payments were made, but this began to change because now lenders could sell these mortgage loans to investment banks that packaged them into MBS, transferring the risk to them and also causing the interest income from these loans to be instantaneous and not spread over several decades. This incentive led lenders to lower their standards and lend more easily, generating an artificial demand that drove up housing prices, increased construction, employment, and attracted the interest of more and more people to own a home, then 2, 3, and more. This facilitated the formation of a bubble, with prices rising and attracting more people, which increased demand and prices, following the classic behavior of bubbles. But where did the money come from to inflate it? Under the current monetary system, when a commercial bank gives a loan, new money is created. This is controlled by the central bank through interest rates that influence the cost of these loans, through the reserves that banks must hold at the Federal Reserve, and through the capital requirements they must have in relation to their assets. Additionally, the central bank is responsible for overseeing that the loans being granted by lenders are prudent to ensure the stability of the system, but the Federal Reserve would fail miserably in all of this. Lenders began to lower the requirements for the loans they granted even more and resorted to options such as loans for over 90% of the home value, grace periods of up to 2 years where only the interest was paid, forgery of documents, false information about financing and repayment ability, among countless schemes to sustain the market but generating a crisis of low-quality mortgages known as the subprime crisis.
I do believe in the American dream. Owning a home is a part of that dream. The single greatest barrier to first-time home ownership is a high down payment. It is really hard for many low-income families to make the high down payment. And so that's why I've proposed and urged Congress to fully fund the American Dream Down Payment Fund.
And the federal government, under the leadership of George Bush, focused its efforts on the so-called American Dream, where people own their own homes. And it did so by making it easier for people to obtain credit, despite their low repayment capacity, through Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are private companies but backed by the government, and their objective is to direct the flow of credit to specific sectors, in this case, the housing sector, facilitating the inflation of the bubble and the deterioration in the quality of mortgage loans. While housing prices continued to rise and interest rates were low, people could refinance their debts and sustain mortgage payments to some extent. But if the quality of the loans began to decline, why did investment banks keep buying them? Investment banks purchased these mortgages and bundled them into MBS, which were then divided into tranches and sold to their clients. The higher tranches were the first to receive payments from the underlying mortgages, but they received a smaller percentage because they assumed less risk, while the lower tranches offered higher returns but carried higher risk and could end up with nothing if there were significant defaults on the mortgages. Although initially these instruments were highly profitable because the bubble kept growing, just like the lenders, investment banks largely shifted the risk of low-quality mortgages to their clients. They also relied on an instrument that would further escalate the problem: collateralized debt obligations. CDOs, or collateralized debt obligations, are instruments similar to MBS, but they include not only mortgage loans, but also vehicle loans, credit card loans, and others. These instruments had much higher returns than MBS, but also much higher risk. Investment banks could get away with selling these highly risky instruments thanks to the credit rating agencies, which became accomplices in this deception. Credit rating agencies are institutions responsible for evaluating the likelihood of default on a financial instrument. Three major companies dominate this market: Moody's, Standard & Poor's, and Fitch. They assigned high ratings to these instruments despite clearly not deserving them, allowing pension funds to invest in them. By law, pension funds cannot invest in assets that are not secure and highly rated, which, once granted, facilitated the contagion of these toxic assets throughout the system and made the risk go unnoticed for many for such a long time, but not for everyone. In 2003, Michael Burry began studying the mortgages that made up MBS and noticed how many of them were filled with low-rated and high-default mortgages, identifying it as a bubble that would inevitably burst with rising interest rates and the end of the grace period for some of these loans. And he wasn't the only one to notice this, with Steve Eisman, John Paulson, Peter Schiff, among others, hypothesizing the same and operating against this market. These individuals would bet against MBS through a third derivative that played a role in this crisis: credit default swaps, or CDS. CDS are financial instruments that function as insurance against default on other financial instruments, but, unlike regular insurance, do not require the person buying the insurance to be the affected party if the risk materializes, or in other words, they don't have to own the instrument they are protecting. Michael Burry and others started buying CDS from major investment banks, a story portrayed in Michael Lewis' book The Big Short and the movie of the same name. If you haven't read it yet, you can listen to it as an audiobook on Audible, the Amazon app that allows you to explore thousands of audiobooks, and you can try it for free for a 30-day period, and you would also be supporting the channel. You can access it through the link provided in the description. These individuals started paying premiums in exchange for these CDS on the tranches of MBS and CDOs that they believed would default when the bubble burst and couldn't collect enough money from the underlying loans. However, soon they wouldn't be the only ones, and in a clear example of how fraudulent the system had become, many investment banks started doing the same.
What do you think about selling securities which your own people think are crap? Does that bother you?
I think they would, again, as a hypothetical.
No, this is real.
Investment banks bought mortgages for MBS and other loans for CDOs and sold them to their clients as safe instruments because they had high ratings, while at the same time acquiring CDS on these instruments because they understood very well that they were toxic assets that would eventually fail. This created a clear conflict of interest and further multiplied the problem, with the derivatives market being several times larger than the underlying real estate market.
We have so many economists coming on our air and saying, oh, this is a bubble and it's going to burst and this is going to be a real issue for the economy. Some say it could even cause a recession at some point. What is the worst case scenario if, in fact, we were to see prices come down substantially across the country?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis.
In 2004, the Federal Reserve began raising interest rates, going from 1% to 2% by the end of the year, and continued until reaching 5.25% in September 2006. During this period, Federal Reserve Chairman Alan Greenspan retired after 18 years and was replaced by Ben Bernanke in 2006. Both denied the existence of a housing bubble or a problem in the mortgage market, despite warnings from reports such as the FBI's alert about increasing mortgage fraud and the 2005 report by Raghuram Rajan, chief economist of the International Monetary Fund, which warned of systemic risks the economy could face, among other publications by renowned economists that warned of the bubble's risk. However, in August 2007, housing prices began to decline, and with that, the bubble burst, bringing down the house of cards that the system had become. The task of solving the crisis fell upon Ben Bernanke and Hank Paulson. Bernanke, as the chairman of the Federal Reserve and an academic who had devoted his life to studying the Great Depression, and Paulson, as the Secretary of the Treasury under the George Bush administration. Both were complicit in the problem that was unfolding. Bernanke ignored the bubble warnings, and Paulson, having served as the CEO of Goldman Sachs from 1999 to 2006, was one of the architects of the deregulation that facilitated the absurd behavior in the sector. The first major alert came from Bear Stearns, one of the largest investment banks in the United States. In March 2008, it faced severe liquidity problems due to its overexposure to assets backed by subprime mortgages. The bank's leverage reached 35-1, and the market stopped lending to them. J.P. Morgan acquired the bank through a controversial deal in which the Federal Reserve of New York spent $30 billion to purchase the bank's toxic assets, allowing J.P. Morgan to acquire a cleaner version of the bank at an excessively low price. In July 2008, it was the turn of Fannie Mae and Freddie Mac. Both entities faced serious liquidity problems due to the lack of market confidence in lending them money, given their excessive exposure to subprime mortgages that the government had promoted through them in previous years. On September 7th, the government took control of both entities through the Federal Housing Finance Agency, and the Treasury Department purchased preferred shares to inject capital. Amidst all this, Lehman Brothers, the fourth largest investment bank in the country, faced serious liquidity problems due to its overexposure to the mortgage market. After multiple failed negotiations for its sale, Barclays, the British bank, decided to acquire Lehman Brothers. However, the deal was blocked by the British government, considering it as importing cancer to the country, and on September 15th, Lehman Brothers filed for bankruptcy. Lehman Brothers' bankruptcy was the largest in U.S. history at the time and marked one of the lowest points of the crisis, causing chaos in the markets and a credit contraction that affected operations of companies in the real sector, which faced serious problems in accessing capital and liquidity. Just one day later, AIG, a multinational insurance company, had to be rescued. This company, which had been selling credit default swaps on mortgage-backed securities and collateralized debt obligations, began to have difficulties in fulfilling its obligations due to poor risk management. Considering it absurd for these instruments to fail, AIG had sold CDS on them as if it were free money. This led to one of the most controversial bailouts of the crisis because the main client of those CDS was none other than Goldman Sachs, and when AIG was rescued, Goldman received $61 billion in payments for its CDS.
In our nation's history, there have been moments that require us to come together across party lines to address major challenges. This is such a moment.
The problems faced by these institutions and the risk they pose to others, which if they were to collapse would have a damaging impact on the entire system, forced the Treasury Department to implement a $700 billion financial rescue program. Initially, this program called TARP aimed to purchase troubled assets. However, after the approval of this package by Congress, Warren Buffett contacted Hank Paulson, with whom he had been in contact during the crisis because his company, Berkshire Hathaway, had accumulated a large amount of liquidity and was waiting to start buying in the midst of the chaos. Buffett warned Paulson that purchasing toxic assets with TARP funds would not be fast enough to alleviate the crisis and that the best option was to recapitalize the banks and stop market fear at its root. Out of the $700 billion, $100 billion went to large banks, which issued preferred shares requiring them to pay the Treasury 5% for the first 5 years and 9% thereafter on the borrowed money. Citigroup received $25 billion, Goldman Sachs $10 billion, JP Morgan $25 billion, Bank of America $15 billion, and Wells Fargo $25 billion. $150 billion went to other financial institutions, and the remaining $450 billion went to the automotive industry and mortgage loan modification programs to assist homeowners at risk of foreclosure. This allowed, to some extent, the crisis from worsening further, but not before it had spread to the rest of the world. The crisis quickly spread globally through financial markets. Many financial institutions around the world had acquired MBS and CDOs, trusting in the strength of the market and the high ratings assigned to these instruments, only to find out that they had little to no value. The distrust and fear also led to a credit contraction that resulted in bankruptcies or the need for government bailouts for companies outside of the United States. Thus, the crisis had consequences beyond the financial sector. The decrease in demand affected international trade and led to a slowdown in the global economy, which was reflected in rising unemployment, impacting multiple sectors from construction and manufacturing to services. The economic and financial repercussions were felt worldwide, highlighting the interconnectedness and interdependence of economies in a globalized world. The Great Recession began in December 2007 and ended in June 2009, becoming the longest recession since World War II. Beyond its duration, the Great Recession was notably severe in several aspects. The economy fell 4.3% from its peak in the fourth quarter of 2007 to its lowest point in the second quarter of 2009, the largest decline since World War II. The unemployment rate, which was 5% in December 2007, rose to 9.5% in June 2009 and reached its peak at 10% in October 2009. The financial effects of the Great Recession were equally enormous. Home prices dropped approximately 30% on average from their peak in mid-2006 to mid-2009, while the S&P 500 index fell 57% from its peak in October 2007 to its lowest point in March 2009. Additionally, a staggering number of foreclosures and bank failures occurred. It is estimated that there were around 10 million foreclosures in the United States between 2007 and 2010, leaving numerous families homeless and submerged in a financial crisis. Furthermore, over 400 financial institutions, including banks and insurance companies, declared bankruptcy or were acquired by other entities due to severe losses on their balance sheets. This reflected the devastating impact the crisis had on the economy and the financial system, leaving a lasting legacy on society. The bailouts of banks, led by some of the wealthiest individuals in the country who had received exorbitant bonuses in the years leading up to the crisis, generated significant discontent among people, leading to movements such as Occupy Wall Street. And although the money the Treasury used to bail out the banks was recovered when these banks repurchased the preferred shares they had issued, and the country even generated a profit of approximately $233 billion from this rescue, this situation set a terrible precedent where some of the main culprits of the crisis did not suffer the consequences of the excessive risk they took. Furthermore, since rescuing the banks allowed the country to emerge from the crisis in a much shorter period of time, it creates the moral hazard that banks may abuse the system again because they would likely be bailed out, so that what could be a recession does not turn into a depression. This is how a market that had grown and been deregulated for decades ended up functioning as fertile ground for the Federal Reserve through cheap credit and incompetence in its supervisory function, the government through policies that promoted subprime mortgages, and individuals, in some cases pursuing the American dream and in others succumbing to greed, to form one of the most dangerous bubbles in history. This bubble was greatly leveraged by lenders who made absurd loans, investment banks that deceived their clients, and credit rating agencies that lied to the public, in a story that demonstrates that you cannot trust Wall Street, the government, the Federal Reserve, or people when they are under the influence of greed. If you found this information helpful, you can support the channel by sharing this video. You may also want to watch this video next. See you next time.